Hi everyone, welcome to JAIIB English Medium. My name is Aarti and I hope you all are doing good. So if you're also preparing for upcoming 25 JAIIB exam, then this is your important series. Because in this we are covering your MCQs as per your IFBF book. And remember, 0.5, 1 marks, 2 marks question, whether that is theory or that is numerical, we are covering each and everything. So what you can do, you can subscribe it to this channel, you can share with your friends and colleagues also, and do watch this particular series from starting till the end. Chaliye, so let's start today's session. So the very first question is, which of the following terms refers to the price at which two unrelated and non-compiled parties would willing agree to a transaction? A, book value price. B, arm's length price. C, enterprise value. D, IFRS. So this is a direct question based on your one of the concepts, that is your arm's length price. So as per this arm's length price, they say that is the price at which two unrelated and non-disparate parties would agree any transaction. Means what? When there is one seller and there is one buyer, take it, this is your seller and here is your buyer. If they are entering into any transaction and they want to identify the price of any goods which they are transferring and they don't know it and they are not related with each other, means they are not the partner at the same company, they are not a family member, or they are not influenced by any other factors. So that is how they are unrelated to each other. So if they want to know the price of any goods, they can use this arm's length price. That is the price through which this unrelated parties will enter into each and every transaction. So as per this, the correct answer is your option B. And remember, under your arm's length price, you have two types of methods. Number A, you have traditional method. Then number 2, you have non-traditional methods. Traditional methods are again further divided into 3, that is comparable uncontrolled price method, then cost plus method, then resale price method, and in the non-traditional method you have profit split and transactional net margin methods. Remember, in exam they can ask you the names based on traditional methods of arm's length price, or they can ask you the name under a non-traditional methods as per the arm's length price. So this is your first question in which they are asking about arm's length price. Chaliye, coming to the next question. That is, which of the following is most appropriate with respect to the issue of shares at a discount as per the Companies Act 2013? We have 4 options. Everyone please read it and tell your answer. Tell me. Option A, that is, companies are allowed to issue shares at a discount freely as long as it helps in raising capital quickly. B, the issue of shares at a discount is prohibited except in the case of issue of sweat equity shares to employees or directors. C, private limited companies are allowed to issue shares at a discount with a special resolution and approval of shareholders. These shares can be issued at a discount only if the company is making a public issue and the discount does not exceed 10%. Now first, let's understand how a company can issue any shares. So basically, company can issue shares at par, at premium, or at discount. These are the 3 ways through companies can issue any shares. So suppose here A option, they are saying that face value is equal to 100. Okay, that face value of the share is 100. Now if company decides to sell the shares at the market for suppose 100 only, so that is known as par. That is known as par. But where company decides to sell this 100 face value share for suppose 150. So as you can see, there is a difference of 50. So now investors need to pay 50 extra. So if companies are selling any shares with extra amount, then you're going to say that companies are issuing shares at premium. On the other hand, if face value is again 100, but now this time company issues for suppose 92. Okay, now you can see face value is 100, but company issues at 92. You can see the difference. You can see the difference of 8 rupees. So this is the discount amount because you are going to collect less amount from the holders. So in India, as per Companies Act 2013, companies are not allowed to issue any shares at discount. In India, we are not allowed as per Companies Act 2013 to issue any shares at discount. Only you have the exception, except in the condition when you are issuing your shares to your employees or directors in the name of sweat equity shares, you can issue the shares at discount. That is the exception given under Companies Act 2013. You can issue the shares at a discounted price only to your employees and your directors, and that share is known as sweat equity shares. Okay, chali. Now let's read the options. A. Companies are allowed to issue shares at a discount freely as long as it helps in raising capital quickly. The answer is no. B. The issue of shares at a discount is prohibited, except in the case of issue of sweat equity shares to employees or directors. Yes, this is what we have seen just now. So as per this, your correct option is answer B. Now let's read the C. Private limited companies are allowed to issue shares at a discount with a special resolution and approval of shareholders. This is again wrong. Shares can be issued at a discount only if the company is making a public issue and the discount does not exceed 10%. Again, this is not a complete, and again this is a wrong option. So as per this, your correct answer is yes, correct answer is answer B. Coming to the next. XYZ Limited anticipates that a small portion of its credit sale may not be recovered in the future. Okay. To account for this, the company creates a provision for doubtful debts at the end of the financial year, even though the exact amount of bad debts is not yet known. Which accounting concept is being followed by the company in this situation? Prudence, going concern, consistency, none of the above. So as per this, you can see that there is a XYZ company. And there is one customer. So customer purchased goods from XYZ company, but there is no cash flow. There is no cash flow at the same time because XYZ sold goods on credit. And here customer promised to pay after suppose 3 months. So though this is a financial transaction, so as a company they are going to record it in their books. As a debtor they are going to show this customer. So this customer becomes debtor to XYZ Limited. Correct? So now goods on credit and customer says to pay after 3 months. Now what happens that after 2 months from this transaction, when XYZ sold goods on credit, after 2 months only, suppose now your debtor becomes bankrupt. Now your debtor becomes bankrupt. So now at this point of time, what XYZ Limited will do? Earlier, when this company sold the goods to debtor on credit, they decided to pay after 3 months, and he promised also. But after 2 months only, means now also 1 month is left. Before 1 month of the final payment by the debtor, this debtor becomes bankrupt. This debtor becomes bankrupt. Okay. So at this point of time, Company knows about the bankruptcy of this customer, of this debtor, but the difficulty is XYZ cannot estimate the loss, but they understood it that they are going to create a provision for doubtful debts at the end of the financial year. Even though we don't know the exact amount, might be we can recover 10%, 2%, 100%, 20%, we don't know anything. But we know that this person is now bankrupt. So for XYZ Limited, they created the provision for this loss, for anticipated loss. So as per this, which concept they have used? Because this loss is future one. Correct. So as per this, which concept they have used? Prudence, going concern, consistency, none of the above. Going concern, they are not talking about the actual liquidation of XYZ. They are not saying the XYZ's company is going to shut down or they are going to wind up. So means going concern concept is not they are talking about. Then consistency. They are not saying that we will not be following this method or we are going to change the methods. Or they are not saying one year we followed straight line method, second year we followed the written down value method, third year we are going to follow units of production method. They are not saying or they are not talking about like that. So again, they are not affecting this consistency. Now let's read the A option, that is prudence. Now as per the prudence definition, if you read, if any company can estimate losses, okay, so they need to record it. In case of losses, they need to record it. So you can estimate loss only for future. But if you find any anticipated profit, you are going to ignore it. What you are going to do? You are going to ignore it. Yes or no? You are going to ignore it. So as per this case, they are saying that they have estimated that in future, the debtor will not give any cash. So for the safe situation, they are creating a provision for doubtful debts. So that is what prudence concept talks about. Correct? This is also known as the concept of conservatism, principle of prudence. So if you are anticipating any losses, record it instantly. But if you are identifying any estimated profits or you are estimating any kind of incomes in your future, you are not going to record in your books. So the correct answer is answer A. Then IFRS stands for A. International Financial Reporting Standards, B. International Financial Reconciliation Standards, C. Indian Financial Reporting Standards, D. None of the above. So as per this, correct answer is International Financial Reporting Standards is your correct answer. Coming to the next. If an investment doubles in 6 years, which is the approximate annual rate of return? This question I gave you in our previous session as a practice question. Correct? So in this question, you need to use rule of 72. So as per this rule, you can identify that in whatever interest you are getting now in that investment, so in how many years you can double your amount. So that the formula in this we use is 72 divided by your interest rate. Correct? So in this question, they have given you that in 6 years, you can double your amount. But what is the interest rate? We need to identify that. So 72 divided by 6, this will give you 72 divided by 6, that is 12%. So the correct answer is option B. Yes, in exam they can ask these type of direct questions also. Chali, coming to the next question. An Indian importer has to pay USD 5,000 to a supplier in the USA. Using the direct quote method, how much amount in Indian rupees will the importer need to pay? You have 4 options. Everyone, please solve and tell me the correct answer. So direct quote means $1 is equal to rupees. Okay, so okay. I missed that. Give me a moment. Okay. I missed that 83.50. I guess this is the missing thing in this question. Okay. Now everyone solve this and tell me the answer. Exchange rate is equal to $1 equal to rupees 83.50. So if an Indian importer has to pay 5,000 USD dollars, 5,000 USD to a supplier in the USA, so they are going to convert it, means how much rupees they require to convert it into 5,000. So directly you are going to do 5,000 into 83.50. So correct answer is 5,000 into 83.50. That is 417,500. As per this, the correct answer is 417,500. Okay, so this is your final correct answer. This is your direct quote. This is your direct quote. Now my question to you all is, can you tell me indirect quote for this? Everyone, please write the indirect quote in the comments. Let's check it out how many of you know how to calculate the indirect quote. So you need to give the answer through the comments, okay? Chale, coming to the next question. The current spot rate, okay. Next, the current spot rate for USD INR is 83.2 and the 3-month forward rate is quoted at 83.80. Based on this information, the USD is at a premium of 0.60, at a discount of 0.6, at a premium of 1, or trading at par with the spot rate. You have the options. Please tell me. So as per this question, you have the spot rate equal to USD INR equal to 83.20, and after 3 months, they are saying that USD INR is equal to 83.80. So in this, the USD is at a premium, at a discount, or at a premium of 1, or trading at a par with the spot rate. Everyone solve this and tell me the answer. So you need to tell me the answer to the comments. Again, this is your homework question. Okay, so this is what they have given. Please tell me this answer. And the next question is, they are issued at a discount to par value. So the interest is effectively rolled up to maturity and usually taxed as such. The bondholder receives the full principal amount on the redemption date. Identify the correct type of bond. Fixed rate bonds, floating rate bonds, C, zero coupon bonds, and D, none of the above. So they are issued at a discount to par value so that the interest is effectively rolled up to maturity, usually taxed as such. And you need to tell the bondholder receives the full principal amount on the redemption date. So that is the type of zero coupon bonds, correct? Now, coming to the next one. A construction company plans to purchase a new earth mover for 3,50,000 in 5 years. Determine the annual savings required to purchase the earth mover if the return on investment is 12%. Yes. So in this, you need to calculate your sinking fund, that bullet amount, correct? Please calculate this. Again, this is your practice question. So today I give you 2 practice questions. So everyone, please try to solve this and tell me your answers through the comment. And in our next session, surely we are going to discuss this. So this is about our MCQ series, but let me tell you that if you haven't started your preparation till now, so you can do your last month concept clarity through this particular batch, which we have already started. So you can visit Twitter 24/7, all courses, JAIIB CIB, JAIIB May 2025. Through this, you can see this is your crash course. But if you are having any Mahapak, or if you are already the enrolled candidate through Mahapak, or already if you have purchased the crash course, then no need to repurchase it, okay? That is the same thing. But you haven't started, you haven't watched any concept classes, or if you have enrolled in only the concept classes batch, then you require this crash course for last month revision, for last month concept clarity. Then you can click on this buy now. Okay, you need to click on this buy now, as you are going to receive the online classes, MCQs, unit wise, that too, and along with that self-study notes. Then you can use one coupon code, that is your Y895, and as soon as you are going to apply it, you can see your discount amount increases up to 77%. And remember, the more you delay your concept clarity, the more difficulty you are going to face in your exam. So try to enroll as soon as possible. And with this, now let's wind up this session. Thank you everyone for joining. Take care and bye-bye.